Hello traders, welcome back to the Forex Gig where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we are going to be talking about the stochastic oscillator, a powerful momentum indicator that can significantly enhance your swing trading strategy. So by the end of this video, you would have a clear understanding of how to apply this indicator to capture profitable swing moves. So stick around with us until the end to learn how to integrate this valuable tool into your trading arsenal and start making more informed trading decisions. What is the stochastic oscillator? And this is a momentum indicator that compares a security closing price to its price range over a specific period, helping traders identify potential market reversals by signaling overbought and oversold conditions. Components of the stochastic oscillator are, they just consist of two lines, which are the K line and the D line. Now the K line measures the current market price relative to its high-low range over a specific period, while the D line is a moving average of the K line, acting as a signal line to smoothing out market noises. How do this oscillator work? It works, the oscillator ranges from zero down here to 100 up here, reading above 80. When you see a reading above 80, this is an overbought condition and it suggests a potential pullback, while readings below 20 indicates oversold condition, hinting a possible rebound. Now there is also another thing we need to know about this indicator is a key use. Traders use this stochastic oscillator to generate buy and sell signals through crossover between the K and D line. Divergence between the oscillator and price action also provides strong reversal signals. Now let's see how we can incorporate this into our swing trading system. We incorporate the stochastic oscillator into our swing trading system, and we would have to follow a step-by-step process. The first step is to identify the market condition. First, you have to determine the overall market condition. Is the market trending? Is the market in a range? Or is the market consolidating? You can also use your average directional index to confirm strong trends for trending markets to align your trade with the direction of the trade. You can make use of your moving average to still know the direction of the chart, and as you can see, when price is below your 100 moving average, it signals that you're in a bearish trend, but when price is above the moving average, this signals that you are in a bullish trade. The second step is to set your oscillator. You adjust your settings. You adjust your oscillator settings. You use a default setting of 14. Then your D line should be 3 and your K line should be 3. You just need this to smoothen out your price. Once you have used a standard oscillator setting of 1433, you can adjust it for more sensitive trend following signals. But using 1433 would be a default setting. You can also use 533 to provide quick signals, but it may also increase noise. The third step is to look for entry signal. The signal you are looking for is to wait for the oscillator to reach an overbought or oversold condition. In a downtrend, you need to see the stochastic oscillator to dip below 20 to signal your selling opportunity. When it's below 20, you can enter your sell trade, and at all these areas it is below 70. You can see it is 18 at this area. This would have been a very good opportunity to take a sell trade. Now for a buy trade, you would want to take a buy trade when you notice price is around sorry, you would want to take a buying trade when you notice price is below 20. Then in terms of a selling trade, you would want to look for a selling trade when price is trading, when the oscillator is trading above 70 or 80. Above 80 is a very strong signal for a selling opportunity and overbought region. So you are looking for selling opportunities at this area where price have signaled that the stochastic oscillator is at above 80 region. While for a buying trade, you would have to look for your signals to happen in an oversold region. When price is below 20, this is a good indication for you to look for a buying trade to the upside. Now you would enter your trade to enter your trade to enter your bearish trade when price is above, when you notice price is above your 80 region. At this area, you would wait for the K line to cross below the D line, which is this blue line has to cross below the yellow line. This is a signal for you to enter your trade at that area. In a buying trade, you would have to wait at this area. When you see price is below the 20, you wait for your K line to cross over your D line, which is this blue line cross over your golden line, golden yellow line, and this will signal a buying opportunity for us. How do we manage our trade? We manage our trade by placing, which is the fourth step, we manage our trade by placing our stop loss just below the recent swing low in a long position, while in a short trade you place your stop loss above the recent swing high. This is how we manage our trade. Then for take profit, you can consider using a trailing stop loss for your take profit region. You can use a trailing stop loss so that you can maximize gains when price moves in your favor. Or you can partially close at key resistance levels. You can close your trade when price gets to this resistance, this support level at this area on a selling trade. While on a buying trade, you can take your profit when price gets to a key resistance area in the market. Now the fifth step is to implement a risk management. Risk management involve your position sizing. Never risk more than 1 to 2% of your total capital, total percent of your capital per trade. Meaning that on any trade you are taking, you would make sure that you are risking at least 1 or 2% of your trading account on that trade. The second way we can implement a risk management is by using a good stop loss. Make sure you always place your stop loss below or beyond your swing highs or swing low to account for market fluctuation, considering when markets decide to fluctuate or move in an irregular manner. You give your stop loss enough breathing space to allow to adjust to the market. And the third risk management implementation rule is to use a reasonable risk to reward ratio. Always aim for a minimum of 1:2 risk to reward ratio to ensure potential gains when taking risks in the market. The sixth step is to use divergence for reversals. Divergence are simply when the stochastic oscillator is making a higher high and price is making a lower high. This is a typical example. At this area, we can see price made a lower low at this area. But if you look at the oscillator is making a higher low. This is a divergence and it signals a potential reversal in the market. The seventh step is to monitor and adjust your trade during certain market conditions. So you have to observe and continue monitoring your trades during your trading section. If I'm to enter this trade, I monitor my trade to see if price is going accordingly how it's meant to go. You can also monitor your oscillator to make sure that price, if you are in a buying scenario, when price gets to your overbought region, you should be wary of that area. You should start locking in profits, securing profits, because an overbought region can signal a reversal to the downside. So you have to stay informed about news events and economic events that could impact your trading circle. So always monitor the market with when you are in a trade. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. And if you found this video helpful, do not forget to like, share and subscribe. Turn on your notification bell so that you wouldn't miss out on more trading tips and strategies. Thank you for watching, and I will see you in the next video.